everybody. I'm your boss, Joe Boss, and welcome to another daily plan. But this time, it's week ahead prep. We're going to be focusing on the future. What's coming up next? You know, if you keep reading news outlets, they, most of the time, 90%, 95% of everything you read in financial media, financial journals, most news is just reporting, hey, what has happened in the last 24 hours? It's usually a review. Generally speaking, the two types of information that can be most valuable to focus on is future expectations. I hang on that a lot. Future expectations and new information, breaking information. So then you can update your expectations. And then, yeah, I could also say there's a third one, which is just valuable insights, valuable review, valuable analysis that puts all that information into a nice presentation or finds a novel expectation, right? But then again, most of those, wrap in a good bow presentation reviews. Most of the really good ones focus on the future and set future expectations anyways, to just review all the information so then you can understand the future expectation in a very elegant way. So let's start with a quick little review of what's happened so far today, because we did get some new information today regarding the flash PMIs, which is kind of a big deal. So flash PMIs, they account for 70% of the respondents for the full final PMIs. The final PMIs, the S&P Global PMIs especially, are used as a leading indicator of all sorts of macroeconomic data. If we're talking about inflation, growth, employment, and the sentiment of all those different things, to have good forecasting power, that's why the PMIs are so valuable. When we get the flash versions, which is the first indication of any new information, right? 70% of the surveys are filled. The final is when we get the remaining, I think 25, 30% is when we get the actual finals. So there are PMIs for every single country. That's what makes the PMIs particularly valuable, is you can look at things on a country by country basis. There are also global PMIs, right? You can see global manufacturing. Oh no, that's for the UK. Anyways, we had European flash PMIs come out, and they came out so well that we got this headline here. I'll read it to you. Traders pair 2025 ECB rate cut bets after German PMI seeing 92 basis points. So effectively, we were expecting 100 basis points worth of cuts. Now the probability of 100 basis points of cuts is getting pared back a bit. So this is pretty good, because ultimately this is, hey, growth is doing somewhat better in Europe, and especially in the UK, if I'm not mistaken. Actually, if we look at the heat map here, you can see the one currency that has green across the board right now is the Great British Pound. So just like with these flash PMIs, knowing what you're dealing with this economic data is extraordinarily important to actually being competent as a trader and setting good future expectations as a trader. Oh, I got a kitty cat that just jumped on my desk. Hello, kitty cat. Yes, hello. Oh, I got a little streaming buddy now. Hello. Hello. Okay, so with a couple interruptions. Okay, please please step away for a moment. I got work to do here. Very, very good. Very good cat. Very, very good Kit Kat. Okay. Let's get back on the road here. So, what's the deal with these S&P Globals? Well, right here is the press release site for PMIs. So we can go here, S&P Global Flash UK PMI. So going to a news site, which, we could, sure, we could go here to economic calendar, and you could probably see right here, right? There is the manufacturing PMI for Germany, United Kingdom, manufacturing and services PMI. The services PMI came out better. The manufacturing PMI came out better than expectations. Same thing with the manufacturing PMI in Germany. It came out much better than expectations. We're going to be getting existing home sales here. I'm pretty certain we also just got, if I'm not mistaken, the US. The US PMI should be coming out sometime, like, imminently. Let's go ahead and check on another monitor here. The updates. Yeah, at 6:45, and the current time, if we go to the charts, is so in about 4 minutes from now. About 4 minutes, we'll get the flash PMI. This is actually a chart of uranium. So right here, this is the Trump inauguration. So this is when Trump declared an energy emergency. And in the energy emergency wording, I'm not going to go and bring it up from whitehouse.gov yet, but I have refreshing some news sites at the moment. Let's see here. Any news? Oh, the president of Mexico says, I don't see a trade war with Mexico. All right. Let me just go over here real quick to the Discord. And let's go to our Trump 47 thread. This happened about 30-ish minutes ago. But whenever oh, excuse me. But whenever stuff like this gets posted, we're putting it into a research thread. And remember, you can always go through these research threads and just find cool stuff. This Trump Watch thread has been especially useful to a lot of people. Speaking of which, one more thing. You know how I pulled up this PMI releases thing, right? It's like, hey, Joe, how do you remember to look up these websites and find this stuff? Well, if you go here to the research form in the Discord, and the link to that's in the description, by the way, just go to the WAP, and so you can click on this category, right? There are these categories, these tags for the research form. And if you just click on outlooks, there will be this one thread here called crowdsourced outlooks. Click on that, and then you'll see literally a whole list of places where you can get outlooks. Now, some of these places require you have, a business email to get subscriptions and notifications. Some of these places require you click a button that says, hey, you're a financial advisor or whatever. You have to get some kind of waiver. Some of these places are just articles. They don't have great outlooks, frankly. But a lot of these places you can just click on and view. There's S&P Global press releases right there, Wells Fargo Advisors, Westpac. And a lot of these will take you right to the subscription link for a lot of this stuff. So if you want to know, where does Joe get all these outlooks and all this data? Well, I don't hide it. And there's also a link right here to trade research resources. This is more in depth, right? This is just like, hey, here's just a bunch of ones that maybe you can subscribe to, maybe you can't subscribe to. And this here is a much larger list that includes places where you can get the subscription feeds also for central banks. I mean, I can pull it up real quick. Oh, hold on a second.
Country and
I have a muted news feed on the side here for RSBN, just in case Trump shows up on a news feed for whatever reason, or there's a headline that pops up. RSBN has direct access, and just so you can see what I'm looking at, right, the RSBN feed. RSBN has direct connections into the Trump administration and the White House because of how much RSBN has supported and archived Trump's rallies. I mean, they've recorded every rally, including the Butler rally, where the assassination attempt was. So RSBN has a really good relationship with Trump, and they get notified very, very quickly. So if they get notified of anything, they'll put it on their network, and I'll see a headline breaking there. So I have that on a separate monitor. So not to get distracted with kind of what's going on right now, and not to get distracted from reviewing, what's going on today. Also, we should be getting flash PMIs right now. There's a lot going on this stream right away. All right, let's see here. S&P is doing really, really well. S&P is up today. Yeah, check that out. We just got the, let's see here, 30-second chart. Yeah, you can see this is where we got our flash US S&P Global PMIs. Also, if we refresh this page here, there you go, S&P Global Flash US PMIs. We can review this, but I'm just going to finish this out here. You get to the trade research resources, and you can see here's all the central banks. So here's the Fed and all of the Fed banks inside it and how to get subscriptions. Bank of Japan, Bundesbank, Bank of Canada. These aren't all the banks, and I'm subscribed to more, but this is just a general list of, hey, here's how you can ruin your email inbox. If you actually go through this page here, it's recommend, and you subscribe to everything on this page. I recommend just having a separate like research, or just have a separate inbox, right? Have a separate email to receive all these things, because you'll get hundreds of emails. I get hundreds of emails a day because of this stuff. And again, that's back here in the Discord. Crowdsourced outlooks is the thread to look for, and the easy way to get there is just to tag outlooks here, right? Go to outlooks, tag it. There you go. There's the whole shebang. And because this is a crowdsourced outlooks thing, if you know a place to find similar resources, you can post that in there, and that's all well and good. The LSEG morning news call is a very nice one. Very, very nice one. Okay, yeah, and then we got a lot of political happenings with the UK and France and Germany and Russia, Ukraine. We got some new stuff around this, with apparently Zelensky and Putin are restarting negotiations here in the last 48 hours. It looks more likely that Europe has more positive upsides. Oop. And so, HOCP. We'll also look at the flash Eurozone PMIs. So this is the US PMIs. Yep, there we go. Let me just check the chat here. All right, all's well and good. Okay, US flash PMIs. Wow. flash PMIs, the composite came in lower. Services came in pretty damn low. But the manufacturing index is back to 50. Huh. Well, that's a nice turn of events. Yeah. So let's see here. US flash PMI survey data signaled further growth of business activity in January. Inflationary pressures intensified to a 4-month high. Okay, that could potentially keep the Fed on hold for longer because, again, this is generally a leading indicator of inflation and CPI. Output and demand. Oh, approximate. Okay, based on 85%. So I need to update this over here. So this is not 70. This is 85. There we go. So let's see here. The slowdown in services were attributed to what? All right, let's see here. Future sentiment. Optimism for the coming year continued to run at an elevated level. That's very good. So sentiment is nice and high. Service sector confidence lost some of the shine, but remained the second highest recorded over the past year, which is good. Manufacturing confidence surged higher, reaching the highest since March of 2022. The largest gain since November 2020. So the US is seeing a really huge boon in sentiment, especially on the manufacturing side of things, which is what you want to see if you're Donald Trump, because you want the manufacturing sector to be motivated to restart capital, investments, to start buying more equipment, to start getting ready to, invest in US manufacturing again. So you have the positive sentiment there. That's very, very good. Let's see here. Anything else? Chris Williamson. Let's see what he has to say. Chris Williamson is one of the best analysts to follow in the industry. There's a reason why he's in charge of the PMIs. Let's see here. Rising optimism is most notable in the manufacturing sector, where expectations of growth over the coming year have surged higher as factories await support from the new policies of the Trump administration through service providers. Those service providers are also entering 2025 in good spirits. All right. However, rising price pressures are a concern. So there's some inflationary concern. Maybe we see that over the end of sometime around March, April, May. We start to see these inflationary pressures. But then again, the assumption going into any inflationary pressures that we get is that those will be transitory, at least short term. If the inflationary pressures last into the third quarter of this year, past the summer, then we will have stickier inflation, and then calling it transitory. Transitory means this inflationary pressure has to subside or be reasonable. There has to be a reasonable expectation that the majority of the inflationary pressure that gets generated here in the first half of this year, if there is any, that it goes away or significantly subsides in the second half of this year. Because the second half of this year is when we're expecting the FOMC to do their freaking rate cuts. So let's move on here. Higher input costs and selling price inflation was broad-based across goods and services. If sustained, could add worries that a combination of robust economic growth and a strong job market and higher inflation could encourage a more hawkish policy from the Fed. That's worth That's worth remembering. This whole shebang right there, that's kind of important. All right, let's go ahead and check out the Eurozone. So everything was really, really good in the Eurozone. I want to just read the comment here at the end. Chief economist at Hamburg Commercial Bank, Cyrus Delaruba. Okay, let's see here. Ahead of the ECB meeting next week. Okay, great. We're getting on topic with the headline of this stream. Ahead of the ECB meeting next week, news on the price front is not encouraging. Cost inflation has increased in the service sector, which Christine Lagarde has said to monitor closely. Selling price, yeah, so this isn't good. This higher price pressure might be due to a weaker euro and the increased CO2 tax in Germany. In the services sector is likely due to increased wages, which rose in the Eurozone at the highest rate since the Euro's inception during the third quarter of 2024, according to Eurostat. However, given the weak state of the economy, the ECB will likely stick to its gradual pace of cutting interest rates for the time being. Okay. So because the economic growth scenario in the EU is kind of crap, the ECB, the expectation here is that the ECB is willing to overlook a bit more inflation that's coming down the pike, coming from taxes and wages and the currency. So taxes, wages, currency. Those are the three pressures that are being identified here. I mean, input prices, yeah, don't get me wrong, but taxes, wages, currency. Those are the three things that are being identified here as inflationary. And so long growth stays pretty low, then the ECB is probably going to continue their rate cutting path. At least this meeting, I don't see any reason not to expect a rate cut still, given this information. At next week's meeting. So let's real quick check out the central banks tab here. Strong confidence that inflation will continue to slow. So that's interesting that Lagarde is saying that after the smart people who run the PMIs, who run the leading indicators, says, hey, we are probably at risk of higher inflation going forward at the moment. And Lagarde saying, hey, strong confidence that inflation will continue to slow. It doesn't drive a huge degree of confidence. And yeah, Larry Fink, BlackRock CEO, says, hey, in the US, the FOMC, we don't think they're going to do any rate hikes. Okay, no rate hikes. That's a pretty common expectation at the moment. Let's see here. Anything else on the docket? Oh, yeah, you can see a rollover. Wow. So we had a nice bump up and we've been rolling over. This is a 30-second chart, by the way. So let's see here. Let's go to net. Everything looks pretty good here to stay bullish on the S&P. Let's go ahead and check out the euro. And the euro bumped up on those PMIs. Don't get me wrong, the PMIs are moving in the right direction. If we look at the economic calendar, let's go ahead and turn this off. Okay. So here's the composite that came out at 50, just above the forecast and in growth territory, which is nice. It seems like the manufacturing sector had the biggest bump and the biggest contribution to composite. And that mostly, it looks like, came from Germany. German manufacturing seems to be getting a bump. Also France, jeez. Wow, France. The manufacturing PMI out of France really kicked some butt today, huh? Services fell, but that's probably why services is holding on tight at the moment in the aggregate European Union composite, right? Why it's grown just a tad. Let's see here. What's next? Okay, home sales and Michigan. Let's go ahead and turn on the squawk from Financial
10
Juice.
seconds.
Let's check out the US stock market.
71.1, 71.1, lower than forecast, 73.2. 1 year inflation final 3.3%, 3.3% higher than forecast, 3.2%. 5 year inflation 3.2%, 3.2% as expected. US existing home sales 4.24 million, 4.24 million higher than forecast, 4.2 million. Existing home sales change 2.2%, 2.2% higher than forecast, 1.2%. University of Michigan expectations 69.3, 69.3, and conditions 74.74.
Okay. Nothing terribly crazy as far as movement goes. Yeah, inflation, a 1 year ahead inflation expectations are staying pretty much flat. All right, we got a link to the full report. Once it loads, I'll pull it up on screen. Looks like the redirects are failing at the moment. Yeah. The website seems to be down. Oh well, at least I have this. Consumers who favor higher tariffs expect lower inflation. Year ahead inflation expectations in green, long run inflation expectations. So year ahead is 1 year ahead, long run is 5 years. Higher tariffs, better for economy. Lower tariffs, better for the economy. Difference, no difference. So median inflation expectations a year ahead 5%. Each. So it seems like we're just splitting the difference around 3% here. All right. Home sales in the US, job and wage gains alongside increased inventory are positively impacting the market. All right.
US Treasury 2-year yield slips after US data, last down 1.7 basis points at 4.267%.
Wow, look at that. Euro is up 80 pips on the day. Wow. It has really rallied since inauguration. Trump has really helped out the euro in this situation here. Or at least the expectation of weaker tariff expectations has certainly helped the euro. I would not be surprised to see 106, 107 from here at this point. Yeah, we're kind of crossing into a threshold here where... Oh, that's just my email. Don't worry. I'll close that. Go ahead and check out the timing dots real quick. Check that out. Let's go ahead and remove the low dots. Oh. I think I had that on the stream. I don't know if you guys could actually see that or not. Was there like a... Has there been a purple haze on that the whole time? Or, you know, the red screen thing on that the whole time? I just have that on automatically. Usually the stream doesn't capture that. Also, it seems like, yeah, something is making the... Yeah, I don't know what was making the visualizer, the auto visualizer go wonky at the top there. Anyways, I think it's reasonable now to set expectations to go up here to 105.6. Like, that's pretty easy to set now. That'll probably be the high for the month. So probably another 60 pips higher. There we go. Nice little positive expectation there. And the question will be, once the tariffs get enacted on Canada and Mexico, what is going to be the net effect? Is it going to make the dollar stronger? That would be my expectation, but because all the manufacturers who usually would be producing stuff to sell to the United States and Canada and Mexico now have to hold their cash instead of, you know, some businesses are just going to stop their business. We'll see what the end impact is of it all. Let's go ahead and check out the Aussie. Wow. This thing is going up, up, and away at the moment. I really don't see a reason why this thing should stop, but just as a little breather to get back to the headline of the stream, ECB, you know, don't get me wrong, but so maybe the expectation goes something along the lines of we top out sometime in the next 2 trading days from here. On the Tuesday, the day before FOMC, the FOMC stays on hold. Powell says something defiant against Trump, ECB cuts, and then you see pullbacks into closes. And we actually have this thing in the indicator called close lines, and you can actually see where these closes mostly occur. So most of the closes from these highs up here point to right here. So let's go ahead, set that to blue, timestamp that. And then we can turn off the close lines. There we go. So yeah, find a high sometime in the next 2 days, pull back into the end of the week, and then we'll review for a month ahead stream towards the end of next week. Pretty much most of next week I'm going to be working on planning out the month ahead. And we'll probably do a stream called Month Ahead and go over with the indicators some targets, some expectations as best as we can. To be frank, as best as we can, given all the surprises of who knows what could happen around Trump. All right, let's continue. Let's do a few of these for... Actually, let's do USD CAD next because we have Bank of Canada. And it looks like the Canadian dollar is gaining strength here. Seems like this trend is about to reverse here. I'm so skeptical. Like, why is this thing holding and drifting lower going into tariffs? Like, this would be... But you would want to own more US dollars going into the tariffs. If you want to sell the same amount of goods, you plus tack on a 25% tariff on top of it. It's just, you have to have 25% more US dollars. I don't know. Maybe the idea is that these companies are going to dip into some kind of reserves that they have set up in order to pay these tariffs initially and then slowly over time increase their prices to match with the tariffs. I don't know. I don't know what the deal is. But considering Bank of Canada is going to be on the dovish side, they're expected to cut. I'm not a huge bull on the Canadian dollar, right? I'm expecting this pair to continue going higher, at least in the interim, especially over the next several months until Parliament is back in action in Canada. And then sometime over here, you have the actual Canadian election going on. So my expectation for like the next 5 months is net to see the Canadian dollar gradually weaken. Maybe not as strong as a weakening as over here, right? Essentially, we're going to get the hockey stick formation. Hockey stick is you have a really steep move, and then you get a angle like that. And just to make it a little more clear, this is what the drawings actually look like. That is the hockey stick. And it maybe looks a bit more clear if I draw it like that. Like you can actually see the, like this is the handle of the hockey stick. This is the spot that you hit the puck with. And so that is the view. You get a hockey stick pattern. A fast rate of increase followed by a more gradual rate of increase. And again, given from now up until there's a new prime minister, this seems reasonable. Seems reasonable to me. I don't have it at the moment, and especially going into the end of this month, I'm not 100% sure, but we can look at some options here. Yeah. So wouldn't be surprised to see us close down here or up here, but not between central pivot and our 0.5. So not in this area that we're currently trading. Either the thing pops up after FOMC or the thing pops down post FOMC. Let's see here. Let's check out the low dots real quick. yeah, so if this is the top for the month, most of the time the low comes in somewhere around here most of the time. Sometimes it comes in a bit lower, but most of the time for USD CAD, the low comes in there. And we can make that one red. 2024, let's timestamp our stuff. 2025, it's a new year. And 0714, always timestamp your expectations so you know when you made them. President Trump is en route to Asheville, North Carolina for the first domestic trip of his second presidency. Right there. Yeah, good stuff. Okay, let's keep on going. And what was the other one I mentioned? BoC, Fed, and ECB. So we looked at Euro, we looked at CAD, and we set expectations. So, don't get me wrong, these are historical expectations. So these expectations could easily not line up. However, the understanding is that these go down into Wednesday. You see continued dollar weakness maybe going into Tuesday of next week. And then once the ECB meeting and once the FOMC, the FOMC meeting's on Wednesday. So once Wednesday hits, you then see some kind of rebound. So something like that. And then, of course, Canada has tariffs following it. So this would be, don't get me wrong, I would like this to be what actually happens. It would make sense to me. So in the meantime, yeah, I'll just leave this expectation. A move, a dip in crypto. A lot of guys who do TA say, hey, you're going to sweep the low here, and then you're going to pop back up after sweeping these lows. I don't view it like that. I'm looking for like, okay, what the hell's going on, right? Or I look for something statistical, right? As for the week here, going into next week, yeah, that's a peak, right? It's a lot easier for me to explain these things. I'm like, hey, that's a high probability spot to find a low for next week, huh? We can also go ahead and look at the probability pivots. Yeah, you can see, look at that. So we can adjust this a little bit down. So there's a lot of seasonal closes here and a lot of seasonal closes here. You kind of have a bimodal setup, right? Shoo. So a lot of closes right here and a lot of closes right here. So if we have a bullish expectation, we're going to focus on the closes over here. And if we have a bearish expectation, we're going to focus on the closes here. If we are okay with interpreting seasonal data for those expectations. And then here, this is non-seasonal data, but it's also not conditional data. This is just using all the historical data. This is like, okay, this is where a lot of lows come in given any week, right? And then over here, yeah, you can see most of the closes are skewed a bit to the upside above the open. So it looks pretty all right. I need to find a way to put some kind of conditional factors into the indicator so then we can filter these probabilities based on like, hey, last week was like this, or using seasonal data, here's the distribution of what things look like. The problem with seasonal data, generally speaking, on these time frames and with this indicator is that there's generally not always enough historical data to generate distributions with. You can, but they're just not going to have super high fidelity. Yeah, I'll keep working on it. I already got I have so many things in the pipeline indicator related, but I'm so busy, doing streams, working on notes, keeping up with the latest happenings. And since the inauguration, it's just been non-stop research. All right. Let's see here. Anything else really to check out? Euro yen moved a lot. Yep, it'll probably close here around the 104s this month. Wouldn't be surprised if it tapped the 105s at some point, but let's go ahead and set that as the expectation. So something like this, just closing here where most of the closes are for most months. You can also look at the seasonal data, see if that lines up. Sometimes it doesn't. Nope, a lot of seasonal closes up here. So yeah, I would be okay with expecting a 164 monthly close. The euro is probably going to continue to strengthen just a little bit, and we'll have to see how hawkish or dovish the ECB is when, if the ECB gets more hawkish in their policy statement or in Lagarde's speech post the decision next week, then we could very easily see euro close in the 165s next week. Very, very easily. 164 is kind of like the safe bet. 165s is, yeah, the ECB is getting hawkish. That's the kind of expectation you need to have if you think we're going to close at 165. ECB is getting hawkish. I don't know. It just, when I read that thing from Lagarde saying, hey, right, over here, strong confidence that inflation will continue to slow. But then we go and we read the PMIs here, and the PMIs say, hey, there's good chance that inflation continues to rise over the next couple of months here. I'm not totally sold on what Lagarde is saying here. She could very easily flip-flop come Thursday. She could very easily flip-flop and send this particular pair just a wee bit higher into the close. Alrighty. So we got some expectations down here. And net everything looks a-okay in my book. We'll have to see what happens the day of, but I got not much else to add at this point. It's going to be a quiet weekend, I hope. Been quite a busy week this last week. Anyways. Alrighty, you guys. With that all said, I will see you all in a